Cameras on.
Thank you so much. Good morning, everyone. Welcome to the New York City Retirement Systems Common Investment Meeting for December 15th, 2016. The first thing we're going to do is gavel in each of the boards. Let's start with Fire. Steve Cassidy, could you call the roll, please?
Yes, John. John Adler.
I'm here.
Good. Susanna Vickers. Philip Duke. James Slevin.
Eddie Brown, I have a proxy for Slevin.
Great. Gerard Fitzgerald.
Here.
Edward Brown.
Here.
John Kelly.
Gerard Fitzgerald, proxy for John Kelly.
Thank you. Jack Kelty.
Here.
John Farina.
Yeah.
Paul Farrow.
Here.
Thomas Fedlin.
Here.
And Commissioner White. He's late. Yeah.
So, do we have a quorum?
Yes.
Thank you. Okay, let's move on to the Police Pension Fund. Kevin?
Good morning. Representing the PBA,
Joe Alejandro, designee for Patrick Lynch, John Puglisi.
Dan Torelli, designee for Mubarak Abdul-Jabbar.
DEA.
Proxy.
Sorry. DEA.
And I'm sorry, and Corey Grable is running behind his time, so I'll have his proxy until that point.
Michael Palladino, DEA.
Lou Turco, LBA.
Chris Monahan, designee, Roy Richter, CEA.
Representing the Comptroller,
John Dorsey, designee for Controller Scott M. Stringer.
Finance,
Did you hear that?
no, Finance, I'm sorry,
Here, Phil Dukes.
Phil Dukes. Police Commissioner,
Rosemary DeBellis, designee for Police Commissioner O'Neill.
and representing the Mayor.
John Adler, representing Mayor Bill de Blasio.
Okay, we have a quorum.
Thank you. Let's move on to Teachers Retirement System.
Right. John Adler,
Present.
Thomas Brown,
Here.
David Kazansky, Deborah Penny,
Here.
Charlotte Beyer, Susanna Vickers.
Here.
We have a quorum.
Thank you, Patricia. And New York City Employees Retirement System, Diane D'Alessandro for the last time.
Chair,
I'm here, Diane.
Comptroller's Office,
Here.
Public Advocate's Office,
Here.
Borough President Manhattan, Borough President Brooklyn,
Present.
Borough President Queens, Borough President Staten Island, Borough President Bronx,
Here.
International Brotherhood of Teamsters, Transport Workers Union,
Here.
District Council 37.
Here.
We have a quorum.
Thank you. And Board of Education Retirement System, Mr. Rich.
We don't have any trustees present, Mr. Adler. Thank you.
Okay, so we note the presence of the Board of Education Retirement System without trustees. And lastly, we have trustees that have arrived since the roll call.
Commissioner Doug White is here.
Okay, any other trustees who have subsequently arrived? Okay, great. Thank you very much. I'm going to turn it over to Scott Evans.
Thank you very much, Mr. Facilitator. I'm going to have Mike Haddad start with the macroeconomic overview. And as a reminder, we're talking about the third calendar quarter ending in September.
Thanks, Scott. So, sorry, I jumped ahead here. I'm going to talk about market returns for the third quarter. And as Scott laid out, just as a reminder, where the third quarter fell, July, August, and September. So it was after one vote across the pond and before one vote locally. So a lot of fireworks happened before and after. These are the market returns for the third quarter for the asset classes in your portfolio. And what I would call your attention to, the second, third, and fourth row on this chart, And notice the rate of return in the third quarter as compared to the rate of the return in the fiscal year that ended in June of 16. So developed equities up 6.4% after a minus 10% in the previous year. EM up 9% in the third quarter. And as a reminder, EM turned marginally positive in the second quarter. And the fourth line is which we're going to spend a lot of time today on interest rates. After a remarkable rally, even in the third quarter, the 11-year duration bucket, which is that Treasury Core Plus 5, returned minus 0.5%. So let me walk through a quick narrative on the third quarter, and as usual, show you guys a few slides on that. So what happened in Q3? So first of all, the post-Brexit response. And as a reminder, the transition in government was very seamless there. The Bank of England lowered rates, they resumed quantitative easing, and they promised more expansionary fiscal policy. The second one ties into the first as well. We had historic lows in yields, with the Federal Reserve remaining very accommodative, not threatening to raise rates. The ECB and the Bank of Japan continuing their quantitative easing programs. So let me just talk about how historic rates got during this time period. So the Bank of England lowered rates from 0.5% to 1/4%. They had been there since 2009. So this is the lowest the bank rate has ever gotten in the history of England. And when we talk about the history of England, it goes back a long time to 1697. So at the same time that they lowered rates, their long rates made historic lows too. And we're talking multiple centuries. Happened in UK, happened in France, happened in Germany, happened in the Netherlands. So I'm kind of laying the groundwork for what Robert and I are going to talk to you later about is managing the duration of your fixed income portfolio. But just bear in mind how low we actually got during the third quarter. So the emerging market rally, what's the story behind that? The concerns in China have remained very low. We know that there's major imbalances in the Chinese economy, but they did not bubble up at all in the third quarter. The Brazil political situation got resolved, allowing assets to rally in Brazil. If you recall, in July we had a coup. There was a coup in Turkey that was repelled within 24 hours. So some volatility, but Turkish assets continued to rally after that. And broadly speaking, oil and commodities were stable during the third quarter. The presidential election, the campaign was in full force in the third quarter, and if you go back to that time, it was widely expected that Clinton was going to win, and the expectation is that her victory would be positive for equities. And the other theme that emerged from the campaign is that both candidates were calling on infrastructure plans. So it gets into the fiscal spending, which is part of the move in interest rates. So despite all this stuff going on, equity volatility after spiking into the Brexit vote then plunged again, and the combination of these factors allowed credit and equity to continue to rally. So let me just walk you through a few graphs real quickly just to illustrate some of these themes. This graph shows global government bond yields for the 10-year for these four different markets over the past 12 months. The third quarter is highlighted in blue. And one thing I'd like to point out on this, despite the historic lows that I talked about, the only developed bond market that ended up lowering yield was the UK. Even the US over the third quarter was up 12 basis points in yield. And if you go back to that first chart of returns where I showed you fixed treasuries had a negative return in the third quarter. So it's consistent with the returns. This graph shows you equity volatility for three major developed market equities. Apologies, I didn't shade in the third quarter here, but you can kind of eyeball it. You can see the spike going into the Brexit vote, and then the collapse with the response from equity markets and, with the central banks and bond markets. And then you can even see we made new lows in equity volatility for these three major markets. This graph shows you the returns for investment grade and high yield. The investment grade scale is on the right-hand side, so you can see a continued rally there. And the high yield scale is on the left-hand side of this slide. This is the equity indices, again for the third quarter, and you can again see the dark blue line showing the rally, and for emerging markets, and emerging markets are the light blue, and the other two right there. So that's third quarter in a brief synopsis. I'll pause there for any questions before I turn it over to Scott to talk about the returns of the individual systems.
Thanks, Mike.
Okay, thanks very much, Mike. So the third quarter was a benign quarter in terms of risk. All the risky assets were beginning to run north, and we can see that in the results of our 5 systems. As we've said in times past, BRRS has the most aggressive asset allocation. It's the most aggressive portfolio, heavier concentration in equities. That shows up in the standard deviation or the riskiness of the portfolio, 8.8 versus 7 for the others. That's a trailing 1-year number. And as you would expect in an environment like the one that Mike just laid out, BRRS had the best results over the quarter, 4.7%. Versus high 3s for the others. Down in the bottom, you'll see the median large public pension fund as measured by the Tux Universe at 3.5. So all 5 of the systems were in the top half of the Tux distribution during the period. So third quarter, this is the first quarter of fiscal 2017, off to a great start. Much better than fiscal 2016, which we've talked about ad nauseum. If you look over to the 3-year trailing results, which ended the third quarter, we're right at about that 7% rate. That's our long-term assumed rate of return. And there's not much difference across the systems or with us versus the median fund. So the longer the period of time that you look at, the narrower the distribution among our 5 funds and also between us and the universe. I want to talk a little bit more about asset allocation than I normally would. This is the normal slide that you see. If you recall, this is the end of September. This is right when you all passed the first of the implementation plans. We'll hopefully pass the rest of them today. But we had not yet had time to react to the new asset allocation because the implementation plans were just being approved. And so what I've done here is to show the portfolios on September 30th versus the old allocation. And you can see that this is a chart you're familiar with. Equities are at or slightly above benchmark in the U.S., right on the benchmark in the developed world, a little above in the case of teachers in emerging markets, and generally on plan with the old allocations at September 30th. In fixed income, very familiar, we were underweight long-term bonds, concerned about rates going up. We've been concerned about rates going up for a while, as you know. That finally happened, but not during this quarter. It happened subsequently. And we were overweight short-term bonds and underweight long-term bonds. This is exactly as it looked at the end of the third quarter. Now what I'm going to show you is the same portfolio, but against the new allocation. And it'll show you how far we have to go in adjusting our existing portfolio to your new allocation. And we'll be talking for several SIMs from now about implementing that allocation. So first, look at equities. Looks quite different when you make the adjustments for the new allocation. We're generally overweight U.S. stocks, particularly in teachers, NYSERS, and police. A little underweight in the case of fire. Very underweight international developed markets in teachers and NYSERS, and a bit overweight in BRRS. BRRS having a slightly different allocation, and BRRS is underweight pretty substantially in emerging markets. Hedge funds, you can see that NYSERS in gold there has no hedge fund allocation. They were still at 1.9%. We're in the process of liquidating that hedge fund portfolio during the third quarter. The rest are on track with the placeholders, and this is an adjusted number, so it shows both our actual private equity and the placeholders that we hold in place of them. And the numbers there are the actual weights, and when you compare those actual weights to the allocation, you can see how much is being held in placeholder assets. I'll note that you have not yet approved our new recommended placeholders. That was embedded into the Statement of Investment Principles discussion. It now appears to me that that discussion is going to go on for a while, and so I'm going to pull out the matter of the placeholders and ask for your approval. Suzanne will be in touch with that. I would like to send something around and have an interim vote on that, because we, in fairly short order, particularly if you implement the remaining plans, we're going to get into a position where we really need to implement those new placeholders, and we'll end up going too far in some asset classes and having to double back. So before we run into those problems, I'd like to get a vote, and I don't think that we can wait the full 3 months, so we'll have some sort of interim vote either in January, either at a January SIM or at another time via email. Looking at the fixed income, this is where there's really a lot of action going on. Again, we're looking at the new allocations versus the existing portfolio on 930. You can see that we're more or less on track with tips and mortgages, a little overweight, very overweight credit, underweight high yield, and extremely underweight treasuries. And the long-term treasuries, you can see almost 10% underweight for teachers, and underweight for police's fire as well. If you remember, NYSERS and teachers took a NYSERS and BRRS took a slightly different tack. Rather than going into long-term treasuries, they went into Core Plus 5 with a similar allocation, and we're very underweight Core Plus 5 as well. Mike and Robert, during executive session, are going to talk to you about our strategy to gradually move assets into treasuries and out of the assets that were overweight over these next months. They have a plan, a fairly orderly plan, and we'll talk about it at length, but obviously it's not something we can talk about in public session. So back to the portfolio. We've added a new feature here, which is the line you see at 171 basis points. What is that? On a geometric basis, that's the return we would have had to have in the quarter to make a 7% annual rate of return. So you can see if the results were above that line, we're ahead of the game in terms of the 7% return. If it's below that line, we're behind the game. I'm going to show you each quarter fiscal year-to-date results. So the 171 basis points will be higher next year or next quarter, because there'll be 2 quarters involved. But as you can see, and Mike set up with the macro environment, the markets were very boisterous during the quarter, up 4%, a little less than 4% for everyone but BRRS, and the benchmarks were up in similar order. Notice that BRRS benchmark was up more.
Scott, I don't know all the individuals all walking around the room taking pictures, but if they could be identified or be told to sit down as visitors, if they are visitors, I would appreciate that.
Thank you. So this is a public meeting, Joe, and
And that's fine. I
yeah.
have no problem with public meetings. Cameras on. Everybody is taking photos.
Well, they're members of the public. I don't think we have a rule that prohibits members of the public from taking photos.
They're entitled to the information. They're entitled to review things. I don't think they're entitled to walk around as a cop. I don't want people walking around with the kids. Okay? As it is, they can sit there. As a visitor, they can sit, review everything. I think the decisions of the board are public. I don't think they should be around, walking around. I don't know what their intent is.
Okay. So I guess what we would ask is the members of the public to stay in the location that has been designated for you, and not to be walking around the table, where the trustees are, and distracting from the CIO's presentation. Okay?
Okay, thanks very much. So if we get back to the presentation, you can see in the left panel, the portfolio, the middle panel, the benchmarks, and in the right panel, how we did relative to the benchmarks, and you can see that 4 of the 5 systems exceeded the benchmarks during the quarter, which is nice to see. Then we have to ask the question, how much of it was due to the fact that we had a portfolio that looked different than the benchmark, and how much of it was due to the excess return or the value added from our managers. And so we do this in this next panel, where on the left is the same excess return that you looked at here on the right panel, and then we break it down into asset allocation. And again, we, as you know, our philosophy is to stay pretty close to the assigned asset allocation, so we don't expect much action in this middle panel, and most of it was in manager value added. I draw your attention to this because, as you could see, this is measured versus the old allocation. As you could see from the allocation slides that I just showed you, when I go forward to the next quarter and for several quarters hence, as we're moving to get the portfolio into balance, this asset allocation part of the portfolio is going to light up. It could be positive or negative, but it's our effort to, on a sort of time-weighted basis, bring it into the long-term allocation over time. Sure, absolutely.
Would it be possible to show both, essentially, against our, because obviously if it's going to bounce around against our old allocation or against the new allocation, there's going to be a bit of difference. Is it possible to show both, or will it only be able to show it against our current allocation or our former allocation?
You want to, well, so when we go to the next quarter, and I mean, we're already into the next quarter, and we've already started to close the gap in the asset classes where you've approved the implementation plans. We're neither on the old allocation or the new allocation, we're somewhere in between. So what you're asking is to see this slide versus the old allocation as well as versus the new allocation?
I guess as to be able, because you'll be in the middle for a period of time,
right?
I imagine. So if it's not possible, then
no. Let me see if it's possible. I'm not sure what state. This is kind of hardwired at State Street, who does this slide. Let me, David. Why don't you and I work with them? But if I understand the request, we'd look at this page versus the old allocation versus the new allocation each quarter until we're kind of there versus the new allocation. Happy to do that, and we can talk offline about what else we might do to find ways to see what's going on.
Absolutely, because we can talk.
Yeah, this is the biggest movement and the biggest change that happens in the portfolio. Every 3-4 years when you guys redo the asset allocation. So it is something to study. It's something to focus on. We're spending a lot of time on it, and the biggest change, the Treasury changes, we're going to walk you through in detail during the executive session, and you all have stuff in your packets about that, and so we're going into great detail about just how we're going to work this transition. Okay. So I'm going to do my sweep now through the value added of the total portfolio. This is the total value added again.
Scott, just to interrupt 1 second.
Yes, sir.
Corey Grable for the PBA has just arrived. I'd like to have him on the record.
Okay.
Yeah, we'll do a whole set of trustees that have arrived when Scott's finished. Okay, thanks.
Okay, so this right panel, which is the manager value added fiscal year to date, is the same panel as we have here. The scale's just a little different on the left-hand side, and you can see fiscal year 2016. So the first quarter got off to a better start than we had in 2016, where the manager value added was slightly negative last year. Breaking it down by equities, we're going to look at the fiscal year to date on the left and the 2-year trailing on the right. I've been really anxious to look at longer-term trends, and I know many of you have. Next quarter, we'll be able to look at 3-year trailing. Why can't we look at 3-year trailing today? Because we didn't start accounting for the portfolio net of all fees until January 1st, 2014, when Scott Stringer started. And we went through that in great detail, but we don't have data that's comparable going back. 3 years is the amount of time we want to look at as a longer-term trend. That's what we should really focus on for performance, and we'll be able to do that for the first time next quarter. But in the meantime, I'm showing you the 2-year numbers. Not too exciting in equities. Equities is mostly indexed, particularly at teachers, so you would expect this to be pretty flat. I'm going to give you a tour of the parts of the equity portfolio that there was something going on, starting with the small cap area. It had been mixed over the past 2 years in terms of the values. The systems do not have the same portfolios, and that's why you see a variety of results. This fiscal year, in the small cap, this is small cap equity space. It'd be small cap core mandate, small cap growth, and small cap value. We were dragging. When I look at the managers, there were a variety of different industry factors. There were several managers that were hurt by materials bets. Now, the oil prices were pretty flat during this period of time. I think they started at 49, ended at 48, and were an average of 44 during the quarter. So there wasn't a lot going on. There's been, oil prices went straight down before this and have gone straight up since. Several managers had trouble in materials during the quarter. If you look at the mid-cap area, it was good. We've struggled a little bit. There was one manager in particular that is part of their normal strategy, is out of utilities and REITs entirely. They had a barn burner quarter, which is good because they've been building character up until now. The emerging manager program, talking about building character, we've been struggling with this for a long time. The results have been very negative. As you know, we've just done a request for proposal. We've restructured this program. We've been working at great depth with the various emerging managers. I'm very pleased with the response that we've gotten, both in terms of the breadth of the bids and the willingness to think about structures where we're truly aligned with the emerging managers with the primary mission, which is to find young talent out there, endorse it, graduate young talent to full contracts. And I think with the new contract, we'll have a much better chance of success than what we've had here to date. International equities is a bright spot. International, as you know, is the one area where we're mostly actively invested, and we have some very fine active managers. Their performance is episodic, as you'll see. Sometimes the growth managers are doing well, sometimes the value managers are doing well, but they've generally added value over time, which is why we confidently still have the bulk of our assets in active management internationally. You can see the fiscal year is off to a great start, and the 2-year numbers are strong as well. It's interesting, if you break it into growth and value, here's the growth. You can see for the past 2 years, not much has been happening, and the 2 years includes the fiscal year to date, which has been terrific. And so before that, actually, growth was underweight, and they've been struggling to keep up with the growth benchmark. We had one manager that just shot the lights out, up over 700 basis points during the quarter. They concentrate the portfolio. They're long-term investors. It's mostly technology and consumer stocks that helped them during the quarter. There were several others that had strong quarters as well, and one that struggled in the growth area. Value, it was kind of a dull quarter. Value's been very strong over time, but it's good to see with all the trouble in Europe that our developed active managers were doing so well. Structured fixed income, which includes a laundry list of things: credit, it includes investment grade credit, includes mortgages, it includes treasuries. Not too much excitement. That's good because that's designed to be a stable part of the portfolio. Although for them it was a fairly positive period in terms of extra value added. High yield, which we do hope for more out of. We were flat this quarter. Robert will talk to you. We're doing an RFP in high yield, and we would like to strengthen the lineup there a bit, and so we'll be looking for additional managers. Bank loans had an off quarter. They've been slightly positive. Their role in the portfolio is to have some active management in variable rate debt, which will protect us when the interest rates rise. And suddenly we're in an environment now in the fourth quarter where interest rates are rising, and so the bank loans will hold up to that in an absolute level better than the nominal bonds. Targeted investments. So our affordable housing programs, they've done terrific as rates have gone down. That is primarily because of the comparator that we have to them. We compare them to Fannie Mae plus 85 basis points. Our loans to developers have a much longer life to them than Fannie Mae does. So when rates are going down, we look like geniuses. We're about to lose our genius status because if you look at the performance this quarter, particularly since the election, with rates going up, ETI is going to look bad. I'm just preparing you for that. Much of it is because this index comparison. We're working to find a better index comparison. We haven't found one yet. But even when you tease that out, we're satisfied with the loan program. We'd like to make more loans to this important area. We only do so when we can get good economics, but we'd love to see more volume in the marketplace here. Hedge funds underperforming. Hedge funds also have a bit of a comparative problem with the index. Hedge funds' role in the portfolio, as you know, is to be a diversifier. They're not supposed to be correlated with equities, and yet many hedge funds are. And the index that we compare ourselves to, the HFRI, has more exposure to the markets than we do. You know, they're about beta of 0.6. We're about 0.2. That's part of what's going on there, and our long-short managers, which do have more equity exposure, did better than the quantitative funds, relative value funds that are not related. But it was a bit of a punk quarter in terms of hedge funds. Now let's turn to private market data, and as we always do, we're going to change gears because we don't have public markets to compare ourselves to, and we have to use a different methodology to determine whether we're doing well or not. Private markets are long-term investments. They don't trade for a long period of time. Then we finally get our money, and we have to ask ourselves whether we've done better than if we just left the money in public markets. So for private equity, as an example, we ask the question, we give private equity managers money. They take it down when they have investments. When they sell the investments, they pay it back. If the exact same cash flows had been taken and put not into these private equity investments, but into the U.S. stock market as measured by the Russell 3000, will we have done better or worse? And that's the comparison you're going to see on a cumulative basis since we started the program. And in private equity, we want to get an extra 3% a year for taking the risks of private equity investing. And that's that solid line at 300. That's an extra 3% a year. The zero is, did we do better than if we just left the money in public equities or not? So for teachers and NICERs, we haven't done better than if we just left the money in private equities. And this is going all the way back to 1999, as you can see on the right. And most of the pain was endured by your predecessors, because at the beginning of the time there was a tendency to have many partnerships with small holdings. When Larry Schloss was here, who's a private equity expert, he changed the underwriting standards to narrow on more highly proven managers. We've continued that process since we took office, and the results have been good. You can see in police and fire and BRRS, which is a newer program, didn't start till 2006, the numbers are positive. They're still not 300 basis points, so we're still not satisfied. We haven't reached the end zone. We certainly won't be spiking the ball when we get there. But things are improving, and there's reason to be optimistic. And we have all kinds of shorter-term things that we look at, which are too volatile to show you here. But we're feeling optimistic. In opportunistic fixed income, here we're comparing versus the old placeholder, which is global high yield. That's part of the equation. The other thing that we invested in opportunistic fixed income is bank loan type stuff, variable coupon leveraged loans. Our new placeholder will be sort of 50% of both. I was tempted to put the comparison in versus that, which is a better comparison, and it looks positive, but you all haven't approved that placeholder yet, so we're going to compare the tougher comparison, and it's slightly negative. But when you really look at how we're doing relative to the true opportunity cost, which is high yield bonds and bank loans, we're doing okay, still below that 300 basis point target. Real estate, you have an allocation to core and non-core or opportunistic, so I show you for the first time what this looks like since inception, going all the way back to 2002 for everyone but BRRRRs, which is 2010. Here, I would note that 2010 is about the time the new underwriting structure came into place, and so we've had better luck in recent years with all private assets, and you can see that in the BRRRR's numbers. And we've been lifting the other numbers up, but we had some tough times in the early 2000s. Interestingly, the more risky stuff, the non-core opportunistic, we've had very good results. And teachers had a large exposure to one manager that invested here in New York and shot the lights out, and that's why their number is so positive. I can talk about that in executive session if you'd like. But that one partnership really made the teachers' portfolio. That was some years ago, late 90s, I think. And no, it couldn't have been because this started in 2002. So it was right around just after 9/11, as I recall, because we were investing in the MetLife building and a couple other things. In BRRRRs, which is a newer program, the results are quite good. It's 800 basis points since the program started in 2010. So there's a lot to be hopeful for here. I would note too that we're using 40% equities to compare core and 60% equities to compare non-core. So actually the non-core's got a tougher comparison, as is appropriate. They're taking more risk. So we're beginning to get better comparators here. Infrastructure, I'm always happy to end on infrastructure. It's a new program started in 2013. There are a few partnerships in here. Petya Nikolova and her team have done a great job of selecting mandates to present to you. You've done a great job of selecting managers, and we're off to a great start. We're not going to hold this kind of, this is versus inflation plus 4%. This is the increment we're getting. And so we'd love to get inflation plus 4%. We're happy to have 600 basis points, but please don't expect that over time as we get a broader portfolio. That's all I have, Mr. Facilitator. I'll be happy to take any questions.
Any questions for Scott for public session? Okay, thank you very much, Scott. So I think that concludes our public session business. Before we move out, I'd just like to put on the record trustees that have come in since we did the roll call. So
John Kelly is here.
John Kelly for fire. Any?
Aldrin Bonilla, NYSERS.
We got you. Okay, Aldrin. Any others? Right, we got that earlier. Any others? Okay, thanks. So now I think we want to have motions by each board to move into executive session. Let's go in reverse order. So let's start with NYSERS. Is there a motion to exit public session, move into executive session for the NYSERS board? So moved. Okay. Is there a second?
Seconded.
Okay. Moved and seconded. Any discussion? All in favor of the motion to exit public session, enter executive session on NYSERS, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay. Motion carries. NYSERS now in executive session. Let's move to teachers. Is there a motion from teachers to move into executive session?
So moved.
Is there a second?
Second.
Okay. Motion made and seconded. Any discussion? All in favor of the motion on the teachers board, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. So teachers now in executive session. Let's move to police. Is there a motion, police? Okay.
Motion to go into public executive session.
Thank you. Is there a second?
Second.
Okay. Any discussion? All in favor of the motion, please say aye. Aye. All opposed, please say nay. Any abstentions? Great. Police is now in executive session. Let's move to fire. Is there a motion of fire to move into executive session? Is there a second? Second. Okay, motion made and seconded. Any discussion? All in favor of the motion to move into executive session at fire, please say aye. All opposed, please say nay. Any abstentions? Okay, let's turn the cameras off. We're now in executive session.
Great. In executive session, an infrastructure investment was presented. Consensus was reached, which will be announced at the appropriate time. A private equity investment was presented. Consensus was reached, which will be announced at the appropriate time. An implementation plan for private equity was presented. Consensus was reached, which will be announced at the appropriate time. There was a presentation on activating a pool of government index managers. An implementation plan for OFI was presented. Consensus was reached, which will be announced at the appropriate time.
Thank you, Susan.
You're welcome.
Do we have a motion to adjourn?
So moved.
Second?
Second.
All those in favor say aye.
Aye.
All those opposed? All right, we're adjourned.
Report out from the actions taken in executive session for the NYSERS board. The board took action on an infrastructure investment and a private equity investment, the details of which will be disclosed at contract. They adopted the private equity implementation plan and the opportunistic fixed income implementation plan, and they approved activation of a fixed income pool, 2 fixed income pools. That's all that was done in executive session. Motion to adjourn?
So moved.
Second?
Second.
We're adjourned. Okay.
We'll introduce ourselves for the record.
Michael Palladino, DPA.
Lou Turco, LBA. Chris Monahan, CEA.
Gary DeRosa, SBA. Joe Lino, PBA, designee for Patrick Lynch, John Puglisi, and I have a proxy of Corey Gable.
Dan Torelli, PBA, proxy for Mubarak Abdul-Jabbar.
Rosemary DeBellis, designee for Police Commissioner O'Neill. Nicole Jambriti.
John Doessa, designee for Controller Scott Armstrong.
Nicole Jambriti, New York City Police Pension Fund.
Lou Rodriguez, designee for Mayor Bill de Blasio and Commissioner Jackie.
Bob Stansky, Pension Fund.
Kevin Holleran, Pension Fund.
Nancy Gagan, NYPD.
Christopher Brad, PBA. Jason Anke, consultant. Rob Affleck, consultant, Wilshire.
Okay, Nicole.
Okay, during executive session, the board heard manager presentations and took unanimous action in the asset classes of infrastructure and private equity. Details to be made public at the appropriate time. The board heard recommendations from the Bureau of Asset Management for implementation plans in the asset classes of private equity, opportunistic fixed income, and hedge funds, and took unanimous action for each of their respective recommendations. Details to be made public at the appropriate time. The board unanimously activated an index within the fixed income asset class. Details to be made public at the appropriate time. The board voted unanimously to make certain adjustments to its hedge fund portfolio and tabled the discussion of other adjustments. Details to be made public at the appropriate time. The board heard recommendations regarding climate change in relation to its investments. The board tabled discussion of these 2 matters. On November 25th, the board took action relating to securities litigation via a unanimous electronic vote. Details to be made public at the appropriate time. On December 14th, 2016, in an attorney-client privilege session, the board heard a recommendation from its counsel and took action via a unanimous vote regarding securities litigation. Details to be made public at the appropriate time. With that, if there's no discussion, we invite a motion to adjourn.
Motion to adjourn. Second.
All in favor?
Aye.
Thank you. Session. The board discussed various investment matters, reviewed personnel decisions, and also made some decisions. We now need a motion to adjourn.
So moved. Second.
Any objections? Hearing none, motion carries. We are adjourned.